everyone, and welcome to the latest edition of the Economist Intelligence Unit's Global Outlook video. My name is Agathe Demarais, and I'm the Global Forecasting Director at the Economist Intelligence Unit. I'm joined today by Emily Mansfield, our Principal Economist for Europe, and Yue Su, our Principal Economist for China. And today we're going to discuss China's economic outlook and the eurozone economic outlook. Before we start, one word about our latest global economic forecasts. We believe that global output, or global GDP, is going to contract by more than 5% this year as a result of the coronavirus pandemic. The US is going to post a contraction of 5.3%, and China is going to record growth, but very low, at 1.7%. However, this is not that bad for China, because China is going to be the only major economy posting growth this year, and actually 1.7% is an upgrade from our previous forecasts. So I'm going to turn to Yue now to discuss this. So Yue, can you please tell us a bit more about our latest revisions to our China's forecasts?
Sure, thank you, Agathe. Yes, we recently revised up China's real GDP forecast for 2020 from 1.4% growth previously to 1.7% growth in 2020. This is because we have observed a better than expected performance in the export sector. And as the world recovers from the pandemic, export performance will continue to add more momentum to China's economic growth in the second half. This is because a lot of China's major trading partners are gradually lifting its economic and social restrictions, and travel bans have been lifted as well, and the global supply chain has been gradually restored. Apart from that, the other factor that back up our upward revision of China's forecast is the stronger performance in investment, especially the public sector investment. During the past few months, Chinese local government has ramping up bond issuance and land sales in order to financing for its infrastructure investment. So we're going to see a continued improvement in construction activities in the coming months. However, we revised down our consumption revision due to the lack of strong policy measures to support the household income for the middle class and wage earners. So overall, we think in the second half of this year, China's economic growth will continue to be supported by investment rather than consumption.
So actually, when we took a look at the second quarter data, China posted a real rebound of more than 12% quarter on quarter. So Yue, do you think that is sustainable, such high levels of growth in the middle of the pandemic?
Yeah, so in Q2, China's economic rebound is really strong. In quarter-on-quarter term, it registered a 12.4% growth in the second quarter compared with the first quarter. And we don't think such strong momentum will be sustainable in Q3 and Q4. This is because what contributes to the Q2 rebound is because of factories clearing up the backlog orders and the short-term surge in demand of electronic devices due to the arrangement of remote workings. And also, because Chinese government rely on a strong administrative measures to bring everything back normal very fast. So these three aspects will not be able to replicate in Q3 because after the backlog orders are fully cleared up and after the transportation and supply side barriers are fully removed. In the Q3, the recovery will more depends on the recovery in the demand side rather than the supply side. However, in China, the market confidence and market sentiment is far from fully restored, especially in the private sector. So in July, the latest data has shown that private investment as well as retail sales is still in contraction. Employment is not improving since June. So the impact to income is still quite significant, and we don't think consumption will be able to get back to positive growth until end August. So the other major issue is that we have seen production growth is constantly above consumption growth.
So after the global financial crisis of 2008-2009, China's contribution to the global economic rebound was very high. Do you think that this time China is going to give the same level of support to the global economic recovery than last time?
Yeah, that's a very good question. So overall, we don't think China's stimulus package will be able to provide the same level of support as it did in 2009, the previous financial crisis. The reason for that is that for this year, China's stimulus package is much smaller compared with the stimulus package in 2009. This year, the stimulus package is just around 4% of GDP compared with 12% in the previous financial crisis. So during the previous financial crisis, China's imports, especially for the commodity imports, has significantly increased in 2 to 3 years. But this time, due to government concerns over debt sustainability, so Chinese government is reluctant to launch a larger stimulus package, which means China's imports, especially on the commodities, will not be as strong as before. The second reason for this is we think that this year China wants to focus more investment on digital infrastructure construction rather than traditional infrastructure construction, which includes railways and power stations. And this means that a lot of the inputs for construct digital infrastructure can be produced domestically. And this means that China's stimulus package will benefit more for its domestic economy this year rather than the external market.
Thanks so much, Yue. That was fascinating. So I'm going to turn to Emily now to discuss the Eurozone outlook. So maybe Emily, as an intro question, where do we stand now in terms of economic damage, and is the recovery underway?
Well, we know now that the Eurozone economy shrank by about 15% year on year in the second quarter of 2020. So that's the biggest contraction in post-war history, and it's wiped out all of the growth in the bloc since 2005. But of course, that is temporary, and we have seen an uptick in some of the more high-frequency indicators since May. So consumer confidence is improving, industrial production and exports are starting to rise again, and retail sales are actually back to their pre-crisis level on average in the Eurozone. In fact, they're slightly above in France and Germany, still lagging a bit in Spain and Italy. And really, this is illustrative of the split that we are seeing in the Eurozone economy. Those northern economies like Germany and the Netherlands have been less hard hit than southern economies like Italy and Spain. Of course, not only were these countries worse hit by the virus, but they also have less fiscal space to respond.
So I think, Emily, if we take a look at the newspapers, there's really a bit of worry, I would say, about a recent rise in case numbers of coronavirus in Europe. Actually, a lot of people are wondering if we're actually going to start a second wave. Should we be worried? What do you think?
There definitely has been a quite worrying change in trend over the last month or so. In Spain, there's now about 140 cases per 100,000 people. France, Belgium, the Netherlands are all around about 50 cases per 100,000 on a 14-day rolling average. And what's really concerning is those numbers have risen quite steeply, quite rapidly. But so far, the outbreaks have been concentrated to specific towns or specific regions, and the numbers are still significantly lower than they were in the peaks in March and April. The average age of people with the virus is also lower now, and that means that the pressure on the healthcare systems is still very much under control. And all of these factors mean that the governments across the Eurozone can respond in quite a targeted way. So local lockdowns, quarantines, test and trace, rather than resorting to a renewed nationwide lockdown. Of course, even these local measures are very disruptive for businesses, but they're a lot less economically costly than a return to a nationwide lockdown. I think this is really the worst case scenario that we can see now for the Eurozone economy.
So maybe the $1 million or €1 million question, how long is the recovery going to take in the Eurozone? When will we be back to normal?
I think it'll take a while. We don't expect the eurozone economy to return to its 2019 size until 2023. And that's on average. So Germany and France, we expect to return to their pre-crisis size in the second half of 2022. But Italy, we're not expecting to reach pre-crisis levels until the very end of 2024. Partly this reflects the degree of government support, the kind of level of fiscal stimulus. Partly it also reflects the structure of the economy. So industrially focused economies are typically recovering more quickly, and those economies with a very big services sector, and in particular with a big tourism sector, are going to have a longer road to recovery. It's worth mentioning the agreement last month on the EU Recovery Fund. This is a 750 billion euro package, and that is important, particularly from a political perspective, the kind of symbol of solidarity that presents. But that money isn't going to start to be dispersed until next year, and we don't expect those drawdowns to peak until 2024. So this is not an immediate solution. And I think really the key question right now is just how tough the new restrictions are going to have to be in the short term to curtail the current rise in the number of cases, and how heavily this will weigh on growth in the third quarter.
Thanks so much, Emily and Yue. We're coming to the end of our video now, and I found it really fascinating, so thanks for your contributions. You can always find our latest analysis on our website, www.eiu.com, or on Twitter @theeiu. And you can keep an eye on our latest research on the eurozone, obviously, and China, obviously, but we also have recent white papers on the US presidential election, the risk of sovereign debt crisis, or growth forecasts for major economies in the third quarter. And you can also follow us on Twitter. Our handles should show nicely on the screen on our personal Twitter accounts. Thank you very much for watching this video, and I look forward to recording the next one next month. Thank you very much. Goodbye.